Hello, everybody. Welcome back to the Optometry Money Podcast, where I'm helping ODs all over the country make better and better decisions around their money, their careers, and their practices. I am your host, Evon Mendrin, certified financial planner and owner of Optometry Wealth Advisors. And thank you so much for tuning in once again. For those who are listening for the first time, thank you so much for joining us. And on today's episode, I'm joined by Yuri Kapilovich. He's a CPA and managing partner of his own firm, Kapilovich and Associates, and we talk about how to do a mid-year check-in on the health of your optometry practice from a financial and a tax planning standpoint. And Yuri shares so much that can help you start preparing your practice for the second half of the year. And as I say that, I can't believe it's already halfway through 2022. And don't forget to subscribe anywhere you get your podcasts, and please leave a review. It's always helpful. Not only to get the word out to more ODs in the community, but also your feedback is super helpful to making this podcast a better and more valuable resource for you. If you have any questions on today's episode, or any thoughts or ideas or topics for future episodes, you can send me an email at Evon, E-V-O-N, at optometrywealth.com. And if you'd like to learn more about me or my firm, Optometry Wealth Advisors, check out my website, optometrywealth.com. And you can schedule a no commitment free triage or intro conversation, and you can talk all about your tax planning or mastering cash flow or investing prudently or anything that's on your mind, and we can see if I can be a resource for you. So without further ado, here is my conversation with Yuri Kapilovich. And welcome back to the Optometry Money Podcast. I'm your host, Evon Mendrin, and I am here today with another awesome guest to talk to us all about accounting and taxes. Would love to welcome to the show, Yuri Kapilovich. Thank you so much for coming on.
Yeah, no problem. Great job on my last name. You nailed it.
Thank you.
It's always a delight. Yeah. I know it's a hard one, so I appreciate that.
Of course.
Thanks for having me on the show.
And I am truly excited to talk to you today all about that riveting topic of taxes. Most of our listeners probably don't wake up in the morning all excited about it, but I think what most people are excited about is to try to figure out how to best manage taxes and to pay as little of it as possible, at least over the lifetime. So hopefully we can give some information there on that.
Absolutely. That's what I'm here for.
And, we're at that mid-year point. And just like many patients are coming in to get a checkup on their ocular health, to see how their eyes are doing, many practice owners, many optometrists in general are checking the health now at mid-year of their practices, of their personal finances, trying to figure out, okay, what do we need to do from a tax standpoint to get them going for the second half of the year? And I want to talk to you about those things, both from a financial health standpoint and especially from a tax planning standpoint. But before we sort of jump into that, let's get a little bit of a background. Like how did you get into tax and accounting? How did you get your own business going, and what do you do now?
Sure. So to take it back, in college, interestingly enough, I always wanted to be in finance. From kind of like when I first entered into the business world and into the college world, I wanted to be in finance. And there was this one time in my sophomore year. So at Rutgers University, you have 2 years that are like standard, like kind of like regular basic classes, and then 2 years in the business school, where it's just this hardcore, all business, all this, your curriculum for your degree right there for 2 years, and then you graduate. So before I jumped in, I wanted to be finance, but there was one class that messed me up, man. Like right before I went to apply to the school, they gave me a C when I really had an A because they confused me with another student. Oh. So I was like, oh no, like how am I going to get into the school? So I was rushing. Literally the decision had to be made like, of course, a month, like it was like a month or whatever it was within that time period, I had to get fixed. Anyway, so my grade was recorded at a fairly low grade that would not allow me to get into the finance program. And then I got into the accounting program thinking I'll do like a little bit and then I'll switch in. But then I kind of loved it. And I, enjoyed the topics. To be honest, I was not super into like the accounting, like, all that complicated auditing stuff and all that. But tax really spoke to me. And my one professor, Professor Goodman, who I remember his name, and he really inspired me. He was the individual tax and small business tax teacher, professor at Rutgers. And he motivated me, encouraged me. I loved the topic. I loved the concepts. And they just, I really enjoyed it. So then I went to work for Liberty Tax, which is an H&R Block spinoff or knockoff, if you will. And I worked for them. And that was an interesting learning experience in and of itself. And then like I said, I just kept falling in love with it more and more. And the high net worth individuals and closely held businesses that they own is where I really started to hone in. And then when I graduated school, I finally got a job. It's another story in and of itself, but I won't dive into it. I finally got a job in Miami with Ernst & Young because my wife, my girlfriend at the time, my wife now, is an optometrist. So at the time, she actually got into optometry school down in Nova Southeastern. And I basically joined her there. And I joined Ernst & Young, working on some of the largest high net worth tax clients, as well as the businesses that they own, mostly structured around real estate. And then I proceeded on. We moved back because I'm from New Jersey, moved to Florida. And then we moved back when she finished her degree. She started working, and I, kind of jumped around a couple firms looking for that perfect place to call home. But all these bigger accounting firms to me were always kind of the same story. The personalities didn't clash. Well, it didn't match, rather. I always was clashing with people. My own personality, my own way to build my own firm was always in the back of my mind, probably for the last 4 years. So then fast forward to July of 2021, right around my wife's birthday, actually. I guess I gave her a present of quitting my job. And so it was turbulent times for sure for me, with some deals that didn't pan out as I had wanted them to, and a few other things that kind of slowed down the progress. But here we are today. Everything is good. I got a contracting gig, and I focus mainly right now on closely held businesses. What closely held really means is mostly flow through, as I call it, which is a partnership, which flows through the income to the 1040s, to the personal returns, or an S Corp or a single member LLC. And I focus primarily on folks who have gross revenues of under 5 million, because I find that is my niche spot. It's not so much a niche from a topic matter, right, or an industry niche. It's a niche of 5 million and below, because I find that that's where I add the most value before it gets super complex.
Yeah.
So that's my quick elevator speech, if you will.
That's really cool. I think there's probably some listeners that may have experienced that same sort of burnout and disillusionment with their big corporate employer before moving on to either a private practice or one of their own. And I know I've seen that too from my side of it. And it's never too late, Yuri. Come on over to the finance side. It's never too late.
I know, but I'm set. That's it, man. I found my groove. But thank you for the offer. I appreciate it.
Yeah.
I'll come to California, man. That sounds better to me.
Come on down. Yeah. And so imagine then a private practice owner, optometrist. They're sitting down. It's June's almost over. It's time to take a look at their business. And there's a lot of metrics they can look at, both from the just the operations of the practice, but let's talk about just from a pure financial standpoint. Like, how should a practice owner just sit down and look at the health of their business from a financial standpoint?
Yeah, that's a phenomenal question. So now you're right. We're right at the cusp of the right smack in the middle of the year. It is a great time to be considering these things. Now, look, in my experience, and again, because my wife is an optometrist, I've seen her work at the private practices. I've seen her work at the opticals and in the back, and it always depends on the structure that the optometrist sets up. So if they are full store, full storefront with the sales of the glasses, that answers your question a little bit differently. Whereas some of my clients who I currently have, I have about 4 optometrists that are in private practice themselves, but they are, kind of like a component of Luxottica or obviously in the back of the Targets or in the back of Walmart, and running only the medical or the optometry side of things, where they're doing the eye exams, and then Luxottica or Target or whatever it is collects the revenue from the sales of the glasses. So let's take a step back for a second and let's think about you're talking about financial health, financial well-being. What should people look for? Again, when it comes to the inventory, if you have inventory, and inventory would be the glasses, it's a good time now it's always a really good time, but it's especially a good time now to look over your contracts, see what your pricing is on the actual lenses, right? And what your profit margin that you're targeting. And also take a look at the structure of your business as a whole. How much are you collecting from insurance for each eye exam? And as well as obviously whether it's medical or it's just vision insurance. But before all of that, and I really should take like multiple steps back, right? The key is, how do you as a business owner even see these numbers, right? What I just said has typically literally two types of opposing reactions. What I just said either goes, what did you just say, Yuri? I don't even know any of those things. And believe me, I've seen a lot of this, right? Like, what is inventory? What are you talking about, right? One end. And the other end is, here's my report on exactly what you're saying. And there's no in between. So the step to me is, if you're on this end and you're saying, what are you talking about, Yuri? Right? Then we got to take an even further step back, because we got to talk about QuickBooks, and we got to talk about what you're doing in your business to how are you figuring out how much you're making. And that question, it tends to be a silly question in most people's minds, but a very, very, very important question, because many people, and I tell this to all my clients, as an optometrist, as a business owner, as a practice owner, as an office owner, right? You're so hyper-focused on the patient care, the sales, the so many things are coming to your mind before you're actually thinking about your profit. And you're running almost as if, by the seat of the pants, so to speak, because you have no idea what the income is. So QuickBooks is a great way to start that process. And then you can get into the more fundamental dynamics of everything else I spoke about. I'll take a pause here because otherwise I'll keep going.
Yeah, and QuickBooks being the accounting system, and
correct.
What are the basic reports? There's 3 financial statements basically that everyone's going to be looking at in their business. What are those 3 reports they need to be looking at, and how do they make sure that, yes, even if they know how to access them, that the numbers are good and accurate and usable?
That's a really, really great question, Evon. So that's a really good question. And here's my take on your question, right? There's a lot of dynamics that go into figuring out whether the numbers are good. But from the report standpoint, if you already have QuickBooks and you're already working with an accountant, you're top notch, you're great, right? That means that most likely 99% likelihood that your numbers are good. Then you're going to go into your reports. You're going to go into QuickBooks. You're going to go into the section on the left side that says reports. You're going to select that. And then there's profit and loss statement and balance sheet. You said 3 because there's a statement of cash flows, but unnecessary really for most small business owners in the optometry field. Balance sheet and P&L, and mostly P&L, which is profit and loss, will give you a lot of the information that you need, as long as, like you said, it is accurate. So what do I look at? When I open up QuickBooks and I press that button for the profit and loss, it generates and automatically defaults towards the prior month's activity. I'm going to see May in yours or the practice owner's financials. I'm looking at gross revenue, which is your gross receipts, which is how much you've made before any expenses from, and if you have the optical piece, both the optical piece and the insurance payments, right? And reimbursements and all of that. Mm-hmm. So that'll give you the total number that you've collected in May. Then I look down and see the expenses, and then you're going to have the net profit. Net profit is, what did you bring in total, less all the expenses that you've had? What's the net number? That net number I look at very specifically. And the first thing that I say to my clients who I have, obviously I'm running their QuickBooks, so it's a little bit different. Mm-hmm. But those that I don't run the QuickBooks for, those that do it themselves, I say, okay, your net profit for May 2022 is showing as $55,000 for just a month. Does that make sense to you? That's my first question. And I pause there.
There's sort of a a gut check then, or not a gut check, but just does this match what you're seeing in the practice?
Yes.
Does it look weird? Does it look funky?
Yes. And there's a lot of metrics to test that, right? So for example, if that number is 55,000 in the profit and loss, I then go to the balance sheet, which balance sheet is going to show me at any moment in time, and I can pick that moment in time by selecting the date, what are the assets, liabilities, and equity of that business. I don't want to overcomplicate things. Assets, cash, liabilities, if you got them, if you owe anybody any money, and equity is kind of like your stake in the business, how much you take home, how much you distribute to yourself, or if you need to put money into the business, that goes there. And plus the profits from prior years or retained earnings. But I look right at the cash balances. As of the end of May, with 55,000 of profit showing for that month, I need to see that cash balance, again, before any distributions, obviously, but I assume that I want to see at least $70,000 in there, because I would assume that maybe last month, say you ended at 20,000 plus 55,000 that you've made, right? That you're telling me you made, that your software is telling me you've made. That cash balance in your bank at the end of May better be around $70,000, $75,000. Now, when I see something different there is when my accounting spidey senses go off, and then that doesn't make sense, right? Because if that was your net profit after your expenses and you didn't take anything home yet, aka you didn't distribute any money yet to your personal bank account from the business bank account, then my question is, why is it not making sense? Why is it not adding up? And that could be an issue in the accounting or in the entries or in something that they've done on the input side that I was not involved in. So that's test number one.
Got it. Okay. So a gut check on the profit and loss. Does that make sense from what the owner is seeing in the practice?
Yep.
And then follow that up by looking at the cash balance on the balance sheet and saying, okay, if you expect this much profit, you should see X amount of cash after that period.
Yeah. And to make it even easier, let's assume that they just started operating. 0 was the beginning balance of May, right? 0, they're just operating. Now we're going to assume that they, really hit the ground running insanely well at $55,000 profit. You should see that 0 number go to 55,000 if that's what you truly made, because in the bank account, you're going to have 0 at first, and then you're going to start collecting income, having sales, and then you're going to have some expenses like paying for the lenses and paying for, your car and equipment and all of this other stuff that is expensible, and that's your profit. So if you spent that, you made it and you spent it, your bank account should be identical to your profit and loss, assuming you started at 0. And when it's not, is when we got to start those questions.
Got it. How do non-cash expense items fit into that? So, or where the actual cash outlay is different than the expense number and profit loss. Like what I have in mind is maybe business debt where interest expense is deductible as an expense, but the full principal and interest payment's actually going to be coming out as cash. Like how do you factor in those non-cash items in that check?
Yeah, that's a really great question, and that's one area where you're going to have discrepancies that make absolute sense, right? Because like you said, principal payments of some loan, for example, if you're for Opter or your equipment for the office, for the testing and all that, your chair, these things are expensive things, right? Your lens, maybe you had a camera, that $150,000 camera that does the back of the eye view. Again, those things people get financed all the time. Either you lease it or you finance it. If you financed it and you're paying off a portion of principal and interest, you're 100% correct. Interest is deductible, but the principal portion goes against that liability. The liability meaning the loan that you took out for that piece of equipment. So the way it's handled, to answer your question, is it's called a journal entry. But what it would do is it'll essentially, if you put the entire payment, let's say $5,000 a month, as an expense in your profit and loss statement, we got to back out the principal piece to offset the loan and make it less. So if out of $5,000, $3,000 was principal, that $3,000 needs to offset the loan amount whatever it may be on the equipment.
Got it. Yep. And to break the listener's brain a little bit more, like the interest part of it is going to be on the profit and loss.
Correct.
And the principal part is going to be handled, it sounds like, primarily on the balance sheet. You'll see.
Correct.
Okay. And listener, remember, principal portion of debt payments are not deductible business expenses. Just keep that in mind. Talk with your accountant. Make sure that looks as it should.
Correct.
Appreciate that. And so, okay, we talked about this first test. What is another test you might look like, or another factor you might look like to check the health of a business?
Yeah. So there is a book out there. It's called Profits First. What that book focuses on is exactly what it says. Profits first to you, the listener or the business owner. Let's talk about it, right? You got to get paid. You're not doing this as a charity, right? You need to bring home money. You need to pay expenses. You need to pay your bills. And that's important to figure out how much are you really making? What is your take-home amount? How are you even paying those bills? Because you got your business bank account, which should be separate. Absolutely, 1,000,000% should be a separate thing. Do not ever combine it with your personal account. Business, personal, separated. Now, on the business end of things, you're operating, right? Now, let's just say you got $30,000 sitting in there at the end of the month, but you got to live, right? Your mortgage payments, your car, or your, whatever it is, whether it's mortgage, whether it's rent, whether it's your food, groceries, is over here in your personal bank account. If your personal bank account has $0 in it, how are you paying your mortgage? You got to take a distribution, which is not an expense. That is an equity item because it goes through the balance sheet. You distribute $20,000, let's say, from a business bank account to your personal bank account to pay all your expenses. So what I mean by profits first and what I mean by all of this is, how much do you or are you taking home on a monthly basis is extremely important. If you are purely patient focused with no sales of lenses because the Luxottica or whoever is handling that, then you are going to be looking at that differently. It's a little bit, I would say, simpler because you're going to deal with inventory, right? What are your patient receipts? How many patients you got to see a day? Let's talk about that, right? To get to where you need to go. A patient exam pays from insurance, unfortunately, $30 a visit at best. Maybe $100 if you're doing cash. So those kind of metrics determine what kind of patients you want to see and what you're gonna make. But let's talk about, let's say, $30 a patient. You see 10 patients a day, and you're open 5 days a week, right? So $30 a day, you see 10 patients. That's $300. $30 a visit. You see 10 patients a day. That's $300 per day. 5 days a week is $1,500, and 4 weeks in the month is $6,000 a month. So if you're seeing 10 patients a day at those rates of $30 a patient, assuming nothing else, that's going to be your $6,000 before any expenses. So we'll pause there for a second. After expenses, right, then the number is going to get reduced. But I will pause right here and just see if how I said that made sense.
Yeah, it made sense to me. And I'm glad you mentioned the book and sort of the takeaway there from Mike Michalowicz. And,
That's right.
Even if you're not using that actual cash management system, one of the takeaways from that book is that you should not be living in sort of this entrepreneurial poverty. You should be enjoying the profits from the hard work as an owner of the business. You should be enjoying the financial benefits of that business, and you should be planning from there. You should be looking at what you need to support your lifestyle, which is where personal planning really is important, so that okay, what does my practice actually need to generate in terms of revenue and then profit in order to support my lifestyle?
Absolutely. Yeah. And what you do is you contact Evon and you speak to him and you figure out, hey, what do I need to live comfortably? What does live comfortably even mean? Because I can tell you right now, I got clients that live comfortably to them is $30,000 a month that they need. Because they got boats, they got this, they got that, they got, cars, they got BMWs, they got Ferraris, the list goes on and on. That's one side. You might be, or someone might be listening and saying more on a conservative side, maybe 5,000 a month. You start there, and speaking to somebody like you is super helpful to get to that point, because not everybody can surmise that on their own. Really, it's hard because, again, entrepreneurs are entrepreneurs doing their thing, and it's very hard to step away from that. And plus there's tax components. So again, not to dwell too long in that book, but that book also talks about having a few accounts set up so that you're constantly, as you're making the money, you're carving out the tax portion into another account that you do not touch, so that what you truly pull out of the business is real after-tax profits that you can use without worrying that you won't have money for taxes later.
Yep. Separate that out. That money is no longer yours. It belongs to the government. Get that out of your hands so that it's not a surprise at tax time, but also so you're not tempted to pull away from it and use it again for the business. And okay, what else? What other things should a practice owner be looking at to check the health? We talked about net profit. We talked about looking at how much they're taking away from the business in order to support their own lifestyle. What are some other things that they should be looking at?
Yeah, I mean, there's so many things at play, and again, and it depends what your practice is doing and what type of practice, how it's set up. If you're paying for your own equipment, maybe it's time to look into your own kind of office and see if it needs something to get renovated, to get into the 21st century, as a lot of places unfortunately do not, and are still, older and have older equipment that's fallen apart, the look of their office. Maybe you want to renovate your office. So many considerations, right? And again, it all depends on the way you are set up, because if you're set up as, in the back of, say, the Target or something like that, most of the time, a lot of your equipment is covered by whoever it is, Luxottica or Target or whatever it is, whoever is owning that optical portion. And then you're paying a rent of some sort. So in that context, it's a lot easier. Then you kind of rest there and you focus on the importance of the patient revenue coming in and what every patient means to you dollar-wise from an exam and a time and all of that. And whether you want to start going for a cash-only practice, which I'll tell you right now, man, it's rough out there with the insurance reimbursements. I can guarantee you every single one of your listeners that's tuning in is hurting for those. They are not kind to people. $30, you're encouraged, right? As practitioners, you want to look out for the well-being of your patient. You want to spend as much time with them, educate them, teach them about everything that you've learned so that they are familiar with what's going on with the back of their eyes, their health, the eye health, all of that, what it means, all the things you can identify from looking at an eye exam. But let's face it, when you're getting $30 a patient, you're at it. You at best are 10 minutes a patient, at best, right? You're churning. And I know a lot of listeners out there, just like my wife is at this crossroads a lot of times where you're like, I really want to provide that help to them, but the business end of things is hurting me. So you'll find people who are phenomenal practitioners, unfortunately, being in the red because of that concept.
Yeah. I mean, we could do a whole episode on that topic alone.
I know.
And when you talked a little bit about profitability, and we talked a little bit about cash and how do you look at maybe a best practice for managing and maintaining and keeping an eye on how much cash is in the practice and just managing cash flow, how much cash is in the practice, where it goes, where it needs to go next, and when it's time to distribute? Like, how do you look at that?
Yeah, it's a really great question. Again, if we take the step back to what I initially said, if you're comfortable with your QuickBooks, if you're comfortable with everything you're seeing on the numbers side, right? Then, and you're comfortable with the bank account, then you can kind of, if you're living in that no inventory, no glasses sales world, then what I always tell my clients is, you set this dollar limit in your bank account. Mine, I'll tell you right, like, is $3,000 that I'm very comfortable leaving in my bank account every month, and the rest is going to get distributed out to me. So think about it in these scenarios, right? Worst case scenario for your business: what are your recurring expenses that you're having every single month that you need to cover, whether it's payroll, a contractor that comes in, such as another doctor that's swapping days with you, or a tech or someone else you're paying, right? What are those steady costs that are happening? And then leave a little bit of a cushion. But let's say your steady costs are $2,000 a month, and then your steady cushion is another $1,000, then you'd be at $3,000. So if you collected $10,000 that month, you can pull out $7,000 into your personal bank account and live off of that. That's the simplest way that I could describe the process. Now it gets a lot more complicated when you're dealing with obviously the inventory and the frames, because those can run another $3,000 for a 6-month supply. And if you leaving $3,000, like I said before, but the 6-month supply was due today. Oh crap! Now I have $0 left in my bank account because I just spent $3,000 on inventory. Well, that will complicate things for you a little bit. So that's the general thing. But go ahead.
Okay. Yep. It sounds like whether you're a corporate sublease without those cost of goods, or whether you're a true private practice dealing with cost of goods for frames and other inventory, the math is just going to be a little bit different, just because the expense number is going to be different. Although I guess in a worst case scenario, cost of goods should decline if revenue is declining as well, and if sales are declining.
Correct.
But there's probably going to be something there regardless. We just went through COVID, and you can look at what you saw through COVID, which hopefully is a worst case scenario in a lot of ways, and see what that looked like. What was the cash flow hit from top to bottom? What did you actually need to get by? And I think you might be surprised maybe at at how lean you're able to keep a cash balance and still keep it going, knowing that you can hold off on your own income, you can hold off on maybe some staff, you can hold off on some cost of goods, but that at least, I appreciate that that at least gives them maybe some things to think about, a little framework to keep in mind as they're thinking about that.
Yeah, I like to have it be palpable and understandable, right? People understand numbers. You can't live off your bank account.
Yeah.
Right. You can't just, sit there and go, I'm doing well. I got $30,000 in there. I'm doing great. But the next day there's a $20,000 payroll expense that you need to cover.
Right.
So living off of your bank account is not a good idea, but understanding, knowing, at least writing down the future upcoming expenses that you have on a monthly basis keeps you prepared for what's to come. And then, really a profit idea, even if you don't have QuickBooks necessarily.
Yeah.
So.
And are you using the cash flow feature inside QuickBooks, or are you using a spreadsheet? Does it matter? What do you think about that?
The cash flow feature. No, honestly, from a cash flow perspective, for all of my clients, and even the ones that I have that are making $1.52 million in a different field, optometry, even those guys, at the end of the day, the principles all apply the same way. How much do you have in the bank account? What are your personal expenses that you need to cover on a monthly basis, mortgage and whatever else, going out to eat with your family and vacation, so on and so forth. Move that on a monthly basis and leave whatever you'd like in the business. The concepts are all the same. So to answer your question, I don't analyze cash flow as much as I analyze real life, purposing, which in the context of an optometrist is how much are you charging per patient, right? And if it's cash is one thing, if it's insurance is another thing. If it's insurance only based, then let's talk about your revenue, gross revenue for the month. Oh, you have 10,000. What did that equate to patient wise? Did it make sense for you? And how profitable are you? And what's your lifestyle like? Are you happy with the fact that of the quality of work that you provide?
Got it.
And that right there, forget cash flow, forget all these other crazy, complicated, super advanced principles. This is all that matters.
Got it.
Right? Because at the end of the day, if you can live on 10,000 a month and you're not going crazy seeing 35 to 40 patients a day, right? Then life is good.
Yeah.
You know what I mean? But if you're aiming to go beyond that and you want to make $20,000, $30,000 a month, well, then how do we get there? And sometimes the answer is cash patients. Sometimes the answer is well, I got to hire someone else and take a little bit of a step back to take 10 steps forward. Those are the conversations that I would be having now if I was an optometrist with my accountant to prepare for the second half of this year.
Got it. And again, that all starts with clarity around what your lifestyle is, how you feel about that lifestyle, and what it takes to get to that. I love that. Let's talk a little bit about now taxes. Everyone's got to pay them. No one enjoys it. We'd all love to pay as little as legally possible.
That's right.
What are some things that optometrists can keep in mind for the end of the year? Some considerations or ideas to help them either better manage taxes, to help limit the amount of taxes they're paying throughout the rest of the year. How should they approach that?
Sure. When it ties into my other point from a little bit earlier, when you're looking at your half year progress and you're looking at everything in a big macro 50,000 foot view and then zeroing in, you might need that piece of equipment, for example, to refurbish, to bring to life your practice a little bit more updated, maybe do some office work around painting or just refurbishing the look of the building. Equipment you can certainly purchase, which will reduce your tax liability. You can take what's known as bonus depreciation, which means you can expense it all or write it all off in the first year fully, even if it's a $20,000 piece of equipment, and even if you're financing it. So even if that $20,000 piece of equipment is costing you $300 a month, you can still take the entire $20,000 value of it in that same year. That said, it is also important, and this is why speaking to your accountant is very important, consistently and frequently, at least quarterly, you should be chatting, because if you take that entire expense in year one, you're preventing yourself from spreading that over 5 years, which is what a equipment life is for IRS purposes. So what that means is if you just started the practice, it doesn't make a whole lot of sense to expense everything right away, all your equipment, right? Because you're just making your loss bigger. Whereas in future years, your income will grow and you can offset a portion of that 20,000 against future higher tax brackets. So it's called tax bracket management. And income management in future years. So again, the short of it is equipment. You can certainly look into that. Any renovations you want to do, all that stuff is deductible. If you, again, from a vehicle standpoint, maybe you want to upgrade your own vehicle, get a new lease for yourself, so long as you're using it for business purposes. And you can prove that is good. Miles tracking is very helpful. I find that miles, for a lot of my clients, do translate to some pretty big savings. From a tax perspective.
I love what you said about the depreciation and managing taxes within brackets over years versus just within 1 year. When I look at tax planning, I try to see it like over a lifetime. Like, how are we really managing to pay as little taxes as we can over your lifetime? But also looking at each and every year to see what are the opportunities within that year. If you look at TurboTax, like all commercials at tax time, it's all about getting a refund, get a refund. It's all about that short-term time horizon. Yeah. And, it's tempting to try to get to zero taxable income, like to try to get every deduction possible and lower your taxable income this year and pay nothing in taxes. But what you want to do instead is to try to maximize that deduction to take care of the highest chunk of taxed income. Get that highest tax bracket, and to do that either within 1 year or to look at doing that with over several years. Like it's just all about looking at, can you get the most from your deductions, whether it's in the business, this can be applied to using retirement accounts, donating to charity. This thought can be applied. You want to look at what is the best way to use any potential deduction, whether it's over 1 year, whether it's spread out over several years. So I think that's something important to keep in mind. And equipment, to talk about equipment, it's equipment that you need. Yes. Equipment that will actually produce a return on the investment.
Correct.
Not just to get a tax deduction. So
correct. That's a beautiful thing you just said, and it happens a lot. The reality of it is there's so much bad advice out there. There's so much of this: buy equipment at the end of the year to reduce your taxes. So people buy this nonsense that they don't need. It sits around it. Let me tell you something. Here's the reality of it. and this, I have this conversation like multiple times, right? Just because it's a write-off doesn't mean it didn't cost you anything.
Yep.
Like, let's dwell on that for a second. A write-off is sold as this amazing thing, but dude, if you don't have the money in your account, or if you only have that money, like if it's a $5,000 piece of equipment and you have $6,000 in your bank account, yes, it's a $5,000 write-off. But you're going to have $1,000 left in your account. And if payroll hits the next day, you're going to be in the negative. So yes, it's a write-off. Yes, it's this great thing to do, but you didn't have any money for it. You still have to pay it.
Yep.
So
You are paying $1 to get $1 to get 40 cents back.
Yes. I mean, well, that's if you're doing really well, and that's great. But but sometimes it's $1 for 25 cents back.
Yes.
So make no mistake that it is not worth it if you don't need that particular equipment, or if you're just doing it for the tax deduction.
Yeah.
And one more thing that I always tell my clients, and I will say this here, we kind of chatted a little bit. Like, nobody wants to pay the taxes, but here's the thing: the more tax you pay, the better you're doing, right? Paying a lot in taxes is actually a good thing, because that means that you're doing way better than that, right? If you're paying 40% in taxes, that means that you're making, a lot of times, say, like over $1 million, right? Now, yes, parting ways with $300,000 hurts, or $400,000, it hurts, absolutely. But the key I tell people is, taxes are great. They're a good thing, paying a lot in taxes, when you're ready for them.
Yeah.
If you are not ready for them, and you have forgotten all about them, and they come back and you don't have $400,000, that's a different story. But you got to pay those quarterly, because here's the thing: if you owe 400,000, and in April you paid 100, and in June, we just passed last week the Q2 estimates. Mm-hmm. You paid 100 in June, you paid 100,000 in September, and then you paid 100,000 again in January, by January 15th, or maybe December, or whatever. There you go. You were planning for it. You were ready for it. You still got plenty of money elsewhere. You just spread it over the time. And then maybe at the end of the year, you do get that equipment that you needed. And now you're in a refund position. Yeah. Because you just did that. You were ready for what's to come. And it's not surprising. But yes, but I have a client that just refuses to pay estimates, because they think they invest the money and they do better investing the money than the percentage of penalty for underpaying the estimates. So every year he has to pay about $400,000, $500,000 in tax, but he's ready for it. Again, I tell we have the conversation throughout the year. Hey man, it's going to hurt this year. It's going to be rough. Okay, I'm ready for it. Then fine. But again, as long as you're ready for it, that's all that matters.
Yeah. And I guess I'll just emphasize what you said earlier about meeting with your professionals throughout the year. This tax planning conversation is not something that only happens in April and then in December. This is something you want to check in with your professionals on, how your revenue is going and profitability is going versus last year. Another example was in 2021, we had a huge amount of expanded credits and different tax benefits and stimulus that did not carry over into 2022. And so if you're making decisions off of last year's tax results, or if you proactively made changes to withholdings or estimated payments based on last year's expended tax benefits, well, you need to make sure that you're keeping in touch for what's going on this year. So these conversations are ongoing. Keep in touch with your tax pro, keep in touch with your advisor, making sure everyone's on the same page and they know what's going on in your life.
Absolutely.
What are some things to maybe watch out for? We talked a little bit about buying equipment you don't need. What are some other things maybe to keep an eye out for, to not fall for, maybe shiny objects to avoid on the tax planning side?
Yeah, it's a great question. The reality of it is, to me, I'm trying to think of anything. I mean, the only thing, the only one thing that's jumping out of me that I would definitely caution people to be careful of is what's called the S Corp election, or the S Corp conversion. Again, social media, the internet, anytime you Google
gotta get an S Corp,
anything related to business, it's always convert to an S Corp for tax savings. We got to stop that. That's ridiculous, because I can tell you from my own experience of my client who's had that advice, created the S corp, and then I had to spend 3 hours of my of time drafting a letter to the IRS begging them to revoke that election because it just didn't make any sense.
Wow.
So you can do it, but just purely doing an S corp because you read about it online doesn't make sense. I will say right now, if you pull up your tax return as the listener from 2021 and your income from your business on Schedule C, which is a single member LLC, if that's how you operate, is in excess of 150,000 as an optometrist. The net income is 150,000. If that's the case, it's probably a good idea for you to convert to an S corp because you have to pay yourself a salary. Mm-hmm. And if that salary is reasonable, well, then, you can maybe, whatever that reasonable salary is, the difference will be your savings. So if your salary is 80,000, 90,000, you have savings of, $60,000 between the 150 and the $90,000 in salary that you took. And that saving is palpable. That's a good savings. That might save you maybe 13 grand, roughly speaking, something along those lines. I'm estimating, but
yeah,
the point is
for the listeners, because you're saving self-employment taxes,
correct,
on the profit portion. Because your own wage, you have to pay obviously employment taxes, but you don't have to pay self-employment taxes on that profit.
That's right. And as a single member LLC on Schedule C, the entire net profit is subject to self-employment tax. So the S corp mitigation is to siphon some of that away from the self-employment tax, put it to an S corp and pay yourself a salary. Therefore, the rest of it is not subject to self-employment tax because S corp profits are not subject to self-employment tax. So that's the general thing. So again, my point here is that is something to be very cautious of in many tales of the accounting, and be cautious too. If the accountant says that sometimes I'm not going to badmouth other accounts because again, I don't know the general rule for most of these people, but sometimes it is an extra tax return, which is an extra fee. And that is unfortunate. And I hate seeing it, but I have seen people who say, yeah, you should convert to an S corp for the sole purpose of charging an extra $800 for tax prep. And I hate it, but some people do it. So be cautious. If somebody recommends the S corp conversion, just check your prior year's tax returns. Make sure that you're over 150,000 in net profit on your Schedule C from your single member LLC. And then maybe it makes sense, but challenge that S corp election.
Yeah, and then you've got potential payroll expenses. You've now got to take a salary. If you have a retirement plan, now you've got to take employee contributions through that payroll. So there's definitely more compliance things to keep in mind. Just keep an eye on all that. And one sort of odd question. Well, we'll talk about independent contractors that are single member LLCs. It's one thing if you own a practice and you've got employees and capital in the business, but you're an independent contractor working for another practice. You are a single member LLC, and because you've heard on ODs on Finance, you should be using an S corp. What is a reasonable salary for someone who is an independent contractor and has basically no other no other capital or employees in that? Right.
And the real answer to that, so the reasonable salary is quite the gray area, right? But at the end of the day, I always say it like this: what would you pay someone else to do what you're doing? And in the context of what you just described, which is a independent contractor working for another doctor in their practice, what if you were to go on W-2, what would you want to get paid? Would you want to get paid $60,000? I don't think so.
Yeah.
Right. Would you want to get paid 100? Yeah. And then does it make minimal sense for you to convert? Yeah. Right. So it's all about that. Very rarely do I recommend for someone in that context, as a single member LLC or as an independent contractor, to become an S corp unless they're making like 200,000 from that business. And at that point, then I would challenge the whole different world of are you really an independent contractor? If you're making $200,000 a year working for someone. You're in there every day and they're dictating everything you're doing.
Yeah, that's a
But
different
that's a whole
discussion.
different point. Yeah.
Yeah.
I won't go too much into that, but that's not necessarily that person's problem. It's more so the employer's problem, who probably has a bunch of, as you said, pension and retirement accounts and does not want to pay in the employee share.
Yeah. We're getting close to out of time, and I do want to ask you one more question
Sure.
about, if we can make it a short one. I'm not sure we can, but
I'll try.
About cost segregation.
Mm.
And there may come a point in many practice owners' careers where they're going to want to purchase their property, their business property, that is, the practice property. They may want to buy a new property to expand, or for financial reasons to hold another asset. When does something, can you explain briefly what cost segregation is, and when might that make sense in those scenarios?
Sure. So the main concept behind a cost segregation study, which has been a lot also in the news, kind of in a lot of out there on the internet as well. Cost segregation study, what it does is it segregates the costs of the overall building into separate categories that are depreciated faster. So what does that mean? If you buy a building for $1 million, let's say it's a commercial property, $1 million is depreciated over 39 years. If you did nothing else, that's commercial property depreciation rules. 39 years, you're going to get $1 million divided by 39 as a depreciation deduction every year. If you did a cost segregation study on that building, it will bifurcate the $1 million into 15-year asset, maybe 7 years, which is furniture and fixtures, and equipment, which is 5 years. On assets of 5, 7, and some 15-year assets, you can get bonus depreciation. So why a lot of people do these cost segregation studies is they try to move a lot, as much as they can, from the $1 million category of 39-year property into 5, 7, 15-year property, so they can write it all off in 1 year and show a $200,000 or $150,000, write-off in that year. Again, perfectly legal, 100% kosher, but doesn't make sense for you, again, as we discussed before, to then, not spread that over 5 years, which could be a tremendous benefit over 5 years if your business is continuously prospering and growing that tax bracket.
So is that because those studies are not cheap? There's a lot that goes into that, and so does that really just start with talking with the tax pro and seeing whether the deduction math makes sense first?
Yes, absolutely. Well, the first thing I would do is if I was an optometrist and I was to consider purchasing the building that I'm currently operating out of and maybe renting out another portion of it, whatever it is, the first thing I would look at are the numbers. Does it make sense for me to purchase it? Can I afford to purchase it? On $1 million property, it's 20% down. You're looking at $200,000 out of pocket to put down on the building. And then you want to talk about, well, what benefits am I going to receive out of this? Right? You're going to get some rent, maybe from other tenants. And then you're going to pay for the cost segregation study, which really the crux of it is someone comes in from these cost segregation firms and they look at blueprints, schematics, everything of the building, and again, bifurcate it. Hey, this is a permanently attached or removable fixture. If it's removable, it can go into the other categories and get depreciated faster. But it's never a simple answer of, yeah, I'd definitely do a cost segregation study without really investigating the numbers. It has to make sense.
Got it. Well, I know I got to let you go. I really appreciate all of your time today. This was fantastic, and I will save my giant list of tax questions for next time. But,
sounds good. I can return.
Where can people find you, follow you, learn more about what you're doing?
Sure. I'm mostly active on LinkedIn at the moment under my name, just Yuri Kapilovich, CPA. I'm also on Facebook with the same name, and I'm also on Instagram as Mr. Tax Guy. But Instagram is currently under construction as I'm trying to figure out the direction that I want to go on that route. But at the end of the day, that's where you want to find me. I'm going to go ahead and just get crazy here and just give you my cell phone number. If you wanted to hit me up and you wanted to reach me and you're a listener and you have a tax question, just shoot me a text, 856-366-3247. Yeah, I went crazy on that one. But listen, at the end of the day, it's truthfully the best way to answer. People shoot me a text and I'll reply to it. And these questions don't even take that long, and we can have a consultation session, whatever you got to do. Even if it means I'll just point you to what to ask your accountant. That's what I'm here for.
Got it. Well, appreciate that. We'll put everything in the show notes that you mentioned today. If you have questions for the listener, reach out to Yuri or to me about anything we talked about. And appreciate everybody listening. We'll see you on the next episode. Take care.
Want more resources to help master your money? Check out the Education Hub on Evon's website at optometrywealth.com. Evon Mendrin is a certified financial planner and owner of Optometry Wealth Advisors, a California registered investment advisor. All opinions of Evon and his guests are their own. This show is for informational purposes only and should not be relied on for specific investment, legal, tax, or other decisions. Clients of OWA may own securities mentioned on this show.